So in this video, we're going to talk about how we can utilize a permanent rate buy down to help you qualify and to reduce your debt to income ratio. So let's look at this comparison that I prepared. Basically what I did was I outlined 3 columns. One is what today's market is currently at. The second one is what today's market is doing for affordability. And the third one is today's market utilizing the permanent rate buy down. So let's just look at this first column. In today's market, if you're a buyer searching for a home, let's just say you see a house and it's listed at $600,000, okay? And you're putting 20% down. Based on the current market as of today, the average interest rate on a 30-year fix, we're looking roughly in the mid-sevens. So I'm just using 7.5 for now. Now, your principal and interest payment on that would be about $33.56, and this does not include taxes and insurance. For illustration purposes, I'm just using the principal and interest since that's what the interest rate is based on. So $33.56 is your principal and interest on a purchase of $600,000 with 20% down in this market. Now, you go to get qualified and you go to your bank, and then they tell you, well, actually, what you qualify for is around $515,000 with 20% down, and the same interest rate at 7.5. That brings your payment to $28.80. So now, because the interest rates are higher, you're having, or maybe it's something else in your picture, but or in your loan details, but you're running into a debt to income ratio, or maybe you're just not comfortable with the payment. So what do? We have to create some affordability utilizing the permanent rate buy down. So if you look at the third column, we're back at a purchase price of $600,000, 20% down, and we're buying the interest rate down by to 5.875. And now what you're doing is you're going in at asking price, and then you're requesting a credit from the seller to buy down this interest rate. So the cash to close that you're bringing is just about exactly the same as what you would bring in today's market without a buy down. So the seller's buying down the interest rate, and you're saving $516 a month. This is for the life of the loan. So that is a huge difference. And then if you look over in the savings column where it says 60-month savings, you're saving $39,000. So higher purchase price, lower interest rate, you're saving more money over the next 5 years. So this is a strategy we use to create buying power. So maybe last year you qualified on a lower interest rate, and now we just have to get a little bit more creative this year. Instead of going in over asking, where last year that's what we were doing, now all you have to do is go to asking price, request a seller credit for the buy down, and you get your buying power back, and you get into the home that you want. So this is a strategy that would work for that. If you have any questions, feel free to reach out. Thank you.